Hey everybody, welcome to Gold Rush Live. Sam is not with us today, so it's just me. And so this is going to go all over the place. I tell everybody all the time that when I came to All Star Charts, the biggest idea that we had was, hey, Jason, you really got to take your like big macro thesis and combining, oil and bonds and gold and all these things and kind of like trim it down and come up with like one idea. You're posting like 10 different ideas in each trade. Um, and so like I had to kind of think about that. And the real answer to that is I trade the way I do because of understanding the macro markets. Like I that's how I grew up learning about trading. The first thing, everybody learns, day trading at first. You try to day trade. Then you learn some fundamentals. You maybe read about Warren Buffett. For me, I got to learn from a trader that was a family member who actually just really understood macro markets and cycles and was a technician, but also like he traded global macro markets. So, he would be talking about stocks he's buying overseas in Russia at certain points, or stocks he's buying overseas in Europe, and then talking about the tech bubble and how he's all in tech stocks, and then moving into microcap stocks and moving into gold miners and talking about the old days when he used to trade futures in the 70s. And so, and when I was a kid, and I said this the other day at the Portfolio Accelerator, he almost sounded schizophrenic to me. Like this guy was so all over the place that it was like he's screaming at the wall, yelling, what the hell, copper, and you're like, who's copper? You're a kid, you have no idea what he's talking about. And then the next minute he's talking about China, and the next minute he's talking about something else. And so like it almost sounded like he was like hearing voices in his head, and for me, like I'm the same way now. Like I connect all these things together. I probably sound crazy to the kids. They probably think I'm insane. And that's totally fine. I think it's for me, connecting all of these factors in markets is what helps me stay on the right side of the trade. It's the reason why I've been able to outperform the S&P 500 for so many years. And so we're going to dive into that today. There's so many things I got to talk about at Portfolio Accelerator. That event is awesome. We bring a bunch of great people together, a bunch of great traders together. The whole analyst team gets to get together, which is one of my favorite parts of it. So all of us just get to chat and talk through what we're all thinking about markets. And so you get a lot of great ideas. One of the best parts of it, though, as well, was going and hanging out with Kevin Muir. Kevin Muir is from the Macro Tourist. If you don't read his stuff, you definitely should. Shout out to Kevin. He had myself and Ricardo went out with him. We got some food after the event. Great guy. Thanks for taking us out, Kevin, if you do see this. And I also got to chat the bond market with him, which made me a little bit more bullish on my thesis, because we were both a little bit on edge for a minute. And then I was like, huh, if basically every single person is thinking bonds will probably go higher here, at least the long bond TLT will go higher here. And Kevin and I are still on the short end. We're still shorting the bond curve. So sorry, we're still short TLT, so long bonds anywhere from 20 to 30-year bonds. I'm personally shorting the 30-year bonds. ZB is a ticker for futures. And for personally like thinking like, there are some catalysts here that could possibly offset our short trade. That means basically everybody's on one side of the boat. And the way to think about that is, if everybody's on one side of the boat's obviously going to tip at some point. And that's what I think about the bond trade right now. So we're going to hop into the charts in just a second. If you guys can, I'm going to go back and forth. I'm in the chat right now looking at a couple things. Hey, what's up, Jonathan? Freely. Great to see you guys. I won't be able to chat back to you much because it's just me today. But feel free to leave questions. I will read them off and try to get back to you as soon as I can. So starting out with the first chart. So here's chart one. So we're looking at the 10-year Treasury bond yield. So, the person who I learned how to trade from, and I'll leave a couple things out that we talked about a Portfolio Accelerator, but I'm going to try to cover as much of it as I can. Some of it's for members, but I'll cover as much of it as I can. So looking at this first part of the cycle, there's a 40-year cycle. This was always taught to me as a very significant part of the cycle. You want to understand where the bond market is at all times. It was something that was taught to me early, and I don't think a lot of new traders get that lesson, which is you really want to understand the bond market because it's the biggest market in the world. Yes, Forex might be bigger, but they're all tied in together. bonds, forex, they tell you about liquidity in the market, where the market is heading, whether you're in an inflationary environment, a growth style environment, a deflationary environment. You can tell I can tell all those things by just looking at the bond market. When you get into this point, like let's look at the 40s, you see bonds bottoming out. That's just after the Great Depression. So the Great Depression happens, if you remember, 1929. Most of you don't remember 1929. Neither do I personally, but I've read about it quite a bit and read many books on the Great Depression. Very interesting stuff. You guys should read Murray Rothbard's book on the Great Depression if you haven't. But basically, we get into this big deflationary shock period that happens. And around 1933, there's a 1933 gold seizure from FDR. If you guys are gold bugs and you ever heard about that, or you like trading gold, like you should definitely look back at the 1933 gold seizure. So FDR goes in, basically puts out an executive order. They end up getting a bunch of gold from people. It basically, because we're tied to gold at that point as the world's reserve currency, we have to get gold to basically create liquidity in the markets. So we get more liquidity in the markets. This bottoms out in the late 30s, early 40s, and then we basically earn an uptrend in yields all the way to 1982. So what happened in that period? So commodities basically started to inflate in the 50s. They started to inflate a bit, started to really take off in the 60s. And then when we get into the 70s, that's the stagflation era. That's the point where, you basically had people going, I can't even go to get gas anymore. Gas is too expensive. Everything's too expensive in the world. And the Fed brings in Volcker to basically kill inflation. So he starts hiking rates like crazy. The long end of the curve, which is what we're looking at here, the 10-year or the 30-year, that just starts skyrocketing because of inflation. So he starts bringing the low end of the curve, which is the Fed rate, up with it. And so this gets to a catalyst in 81, 82, and that basically puts in the top for bonds and yields all the way until 2020. So that was a 38-year cycle that time. It's around 40 years if you go all the way back to the beginning of the United States. But basically, there was an easy money period after that. You get from 82 on, basically you could buy any stock in the book. You make money most of the time. Like, only time where that really started to happen, where it got a little frothy in that, was 2000, 2008. So we saw the tech boom, we saw global stocks boom during the 80s. We saw a bunch of things kind of happen during that time. So the market just kept going up, bond yields kept going down, and that created the 60-40 portfolio that we all know today. Everybody wanted the 60-40 portfolio because you couldn't lose. Bond prices just continued to go up. If the market ever pulled back, you were safe in bonds. So basically, you were able to make money for that 38-year period of time very easily. And then it gets to 2020. That changes. 2022 being one of the worst parts of that, where you had stocks going down 20% and bonds going down around 20% as well in 1 year. That hasn't happened since, basically going back to the 70s, early 80s. So then you see the shift. That's kind of a paradigm shift into getting out of this trade that was kind of the easy trade to make money for all these years. So now where are we at today? And that's kind of the question we're going to answer today. So where we're at today, we've got bond yields bottoming. That's 2020. Basically at that point, we had COVID, the whole economy shut down, crazy crash in the market. If you were trading it at that time, there was points in that where I was running a fund and going, am I going to ever get the money out of the market? That's really how I felt. Like, it was really that insane at that point to be a trader during 2020, because you were just, if you were short and you were making money, it was just kind of like, well, this is cool. I'm glad I'm on the right side of this trade, but will this ever end? Because it was, huge 10, 20% moves. Like, the whole stock market was moving down 10% a day. So it was pretty wild at that time. And so we come out of that period of time. Basically, it was in March. If you guys were following me all the way back then, you could hear me talk about some really wild stuff, universal stuff, that talked about the top in the bond market in March and how it was probably the top for a long period of time. Surprisingly, surprisingly to a lot of people, that was right. The bond market topped at that point, or as we're looking at here, yields bottomed. And then we reversed into a different environment, which was more inflationary. So now we're in this inflationary environment, and we've been here for a while. And so I think the thing is, how do we trade it now? Is it going to shift? Are bond yields going to come down now? Is that something that we're going to see going forward? Um, Wavy said 60-40, 60% metals, 40% energy. That's awesome. Uh, hey, what's up, Nick? Good to see you. My buddy's Nick's on here, so you guys should say hi to Nick and follow his stuff. He's a great trader. Um, Knows a lot about cycles in the economy. So getting to the next one, now we're looking at this chart, which is the same one you guys see me post all the time. Sam was like, we're at the event, and Sam goes, Jason, are you gonna use the gold, copper, oil chart? And I was like, yeah, Sam, of course I'm gonna use the gold, copper, oil chart. Because really, in the end, like I'm kind of like an old man with trading. Like, and I've always been, which is like I really pay attention to that small basket of things very closely. Like if it's gold, if it's copper, if it's oil, or if it's some intermarket thing I'm using, or if it's the multiple futures I use, I basically just trade the futures markets, the ETFs. I get into the individual stocks through those avenues, and that's the way I trade. So every time you guys are going to get kind of similar things from time to time, but there's a reason. It's because these updates are the most important things I've found through back testing over the years. And if we can get this right, we're going to get the rest of the trades right. So gold moves first, copper leads oil, oil moves last. You guys have all seen this. But what I want to bring up today is the fact that the cycle works for a reason, for a reason. So I said that wrong, but you guys know what I mean. Anyways, the cycle works a specific way, which is gold starts to move. You start to see people, it's either worry about the economy, the world, something. People start running into gold. Even people start getting worried about currency debasement. So next thing you know, people start running into gold. Next thing you know, copper starts to move. Why does copper move? Well, when they're looking for gold, they're also finding copper as well, but also they're going to need more copper to basically start to run the world as well. If there was actual monetary debasement and there's more liquidity in the market, think of a falling dollar scenario, you're going to start to get that global growth story happening, which we're seeing today. So now all the money's going into these emerging market economies. I just posted a post about this yesterday. You can see that on my blog on Substack, Against All Odds Research, or at All Star Charts. It's on both already. I thought it was significant enough to just post it everywhere. So looking at copper next, copper starts to move, tells you the global growth story. And then when they're digging all these things out of the ground, how do they get them out of the ground? What do they need? Well, they need more oil. And so this creates the cycle. So basically, when you see those tops in gold, and everybody's looking for gold at this point, there's everybody in the world is out there, and they're trying to, and this hasn't happened yet. So this is part of the reason why I'm still so bullish on gold. We're not seeing everybody out there starting exploration gold mines. We're not seeing everybody merging with a ton of companies. We're seeing some of it starting, but not to the level we'd see in, like, let's say 2011. So when that starts to happen, people need more oil to get this out of the ground. And this really kind of creates a cycle. This also creates those divergences at times where you see oil, like gold doesn't break down, but gold just kind of goes sideways, and you'll see oil just kind of skyrocket for a little while. That's the fundamental moves behind that. And so next up, we have Dow Jones Industrial at crude oil. This is one of my favorite charts to look at, not because like I'm like here trying to fade this or trade off of this every single time. It's because when this gets to a specific level, you start to see that, and my uncle used to call it this relative value. He used it in a different way than most people would use it today, but relative value to me basically means like you compare the Dow Jones Industrial Average to oil, you compare gold to bonds, something like that. And at the moment, we're seeing that stocks are leading the way. The Dow Jones is heading up as well, and it's strong, but we are into that relative value zone where we do usually see reversals. The only time we got way above that, and if you put any other chart on here, like let's say we take out the front month futures contract in oil, that's the one that went negative. The rest of everybody's like, oil went negative. Well, oil didn't go negative. The front month futures contract went negative because of a storing situation. So you'll see this big spike here that happened. But if you put another, let's say you took the front month future out, that was April 2020, you'd have oil spot price ending up in this danger zone right here. So we're at that zone where we usually see these reversals. It doesn't mean I want to go crazy and start buying the crap out of oil and energy stocks. It just means that I want to pay attention here. Like, this is a good time to start thinking about exactly what the discussion is about today. And it's, when will energy move? We already got gold moving. I don't need to keep telling the gold story. It looks great. We'll talk about gold a little bit later, but you guys know it's moving. Copper started to move. Yes, it came back a little bit. People love to talk about that, but look at the international copper names. Look at copper miners, global copper miners. They look great. So between those things, I'm still bullish on copper. And also, if you look at international copper prices, they didn't get hit like ours in the United States. So we're still seeing a lot of strength in copper as well. So XLE to TLT. This one is a very great one to continue to pay attention to. And I think everybody should have this chart. Like, don't and never be afraid to like find somebody. If I post something, like, feel free to take it. I do not care at all. That's how we all learn how to trade. Like, nobody learned. I didn't get all these ideas from myself sitting here in my room and just going, I am so smart, I will figure it out. It's either I read it in a book, I learned it from someone else, I saw it on Twitter, I saw it on YouTube. That's how people learn how to trade. So feel free to take anything you guys see here. But yeah, looking at TLT to energy, and I keep saying, like, you got to pick one at this point. So many people are like, TLT is doing great, and I really like energy. Like, look, if you really look at TLT and you look at it objectively, it's not doing great. TLT is headed into a downtrend. Well, sorry, headed in. It's been in a downtrend since 2020. So it's been a nasty downtrend. It keeps moving down. You have periods of bounces. However, it just keeps moving lower. That doesn't mean it can't move up. It would just be surprising. There's a lot of reasons, and a lot of guys even on the team have reasons to be bullish. And I'm not saying anything against that. I think, TLT, if the scenario is TLT bounces here, I think it could bounce. But I think either way, even a bounce is going to turn lower at some point because of the underlying inflation. If the Fed isn't hawkish enough and they continue to cut rates and they continue, let's say they talk a little bit more dovishly than the last meeting, we'll get into a situation where inflation gets out of control. And the long bonds are priced primarily to inflation and growth. And so the short end of the curve, and I've covered this before, but I know there's new people on here, new people every time. The bonds don't trade. It's not just I want to own bonds or I don't want to own bonds. It's, where do you want to own bonds? You want to own the 3-month bond futures? I do. That's what I want to do. Why do I want to do that? Because the Fed's cutting rates and they control the short end of the curve, meaning when they're cutting rates, the short end bond prices will go higher. But what about the long end of the curve where TLT is 20 plus year bonds? Well, that can turn lower. The price of TLT, meaning yields could move higher while they're cutting rates. It's happened before. It just happened last year. So this could happen again. So once again, it's what's going to happen in the long run? I think inflation is going to come back in a nasty way in the long run. I think the market's telling us that. I think international stocks are telling us that. I think the dollar's telling us that. The next thing to probably start to move lower pretty quickly and in a massive way will probably be bonds at some point. Now, is it a bounce and then they turn lower? Possibly. Does it just continue to break down here? Possibly. But I'm still making the bet. Shorting bonds is still the play. Look globally at yields. I posted this. I think we brought this in a video 2 weeks ago. Basically, you look at Great British bonds up in an uptrend, continues to move higher very quickly. That's the 30-year bond. You look at the 10-year. Then you look at the Japanese 10-year. That one's parabolic right now. So their bond yields are going higher. You look at Canada, it's consolidating very similar to ours. Wherever you look, you're starting to see like uptrends in bond yields if you look at it in a long-term time frame. So I would bet, you always want to bet with the primary trend as a trader. Any technician will tell you that same thing, but when it comes to things that they feel a certain way about or are biased on, they will change their mind a little bit. It doesn't mean they're wrong. It just means that, you got to think about it. If I put this chart up and it was anything else besides bonds, if, TLT was at this point, let's say that's energy. besides people feeling like they're going to get a deal, they're going to be like, oh, energy's trash. Most people would say, especially technicians, they'd all say energy's trash. But if it's bonds, they go, well, the Fed's doing this, Operation Twist this, Operation Twist that. And I'm not saying any of that's possible. Kevin and I talked about that the other day, Operation Twist, especially with the way Donald Trump is, things can happen. But until, you really get that signal that something has really changed or shifted, you want to stay short. Not to mention, if the price is in a downtrend, I'm going to be short it basically no matter what. Anybody could be saying anything to me. I always say the same story, where if God came down to me and said, Jason, I know bond yields are going to go lower right now for the next 10 years. You're going to lose everything in your account from this trade. I'd tell God, hey, sorry, God, my signals are still telling me to be short bonds and TLTs. So I'll be short bonds for a little bit longer here. And that'd be it. And so moving on to the next one, you see the same correlation with copper. One of these is always the winner. Like that's the biggest thing from the conversation today to take. Like if you really believe in, copper miners moving in a big way, and you really believe in energy stocks moving at some point, or you really like the gold trade, most of the time you're going to see that uncorrelation here. Like gold, not every time. Like gold sometimes can go up with bonds and so on. But if you look at copper or energy or lithium miners or any of these things in the commodity space, you're going to see they have a big negative correlation to bond prices. And so now looking at COPX, copper miners, that's a new high. We have some resistance up here, sure, but I don't think it's really going to care about that resistance, to be honest with you. It's not much. There's not a ton of volume up here. So I do think that this trend is going to continue. I think XME is saying it loud and clear. So I really like the idea, stay long the copper miners, stay long XME. I think the copper miners are probably the trade in the year end. I think that's going to be the interesting one. Energy, I can't really make a call on yet. I'm watching it. I think it should be on everybody's chart to pay attention to. A weekly close over 100 on XLE. I want to buy that thing. But right here, what we're looking at, I think copper is probably that next trade that we're looking at. So the copper to gold ratio, that's something that's just been, and if you guys have any questions, feel free to chime in. I'm jumping back and forth a little bit, so feel free to just drive in. Must consider government intervention with bond rates at the short end. We'll keep rates down on that side. So that was David. Yes, short end of the curve. So we covered that earlier, saying like I am long the bonds on the short end of the curve. But that doesn't mean that the bonds on the long end of the curve can't go up. Doesn't even mean that's bearish for the market. So that actually could be a scenario where the yield curve keeps widening and it actually makes more money and more liquidity for the market. And also tells you inflation's on the way. It probably would continue our cyclical trades in the right direction. So now that we're looking at the 10-year yield here, what do you see here from one end of the chart to the other? So that's the divergence. So what did we talk about earlier with the 70s? The 70s basically told us one thing very clearly, which is stagflation is a much different environment than most people have ever traded in. And today we can say that even more so because most people have never even traded the 2000 environment or weren't paying attention to markets at all during that time where we did have inflation, especially in oil went up 300%, I think, from 03 till 08. International stocks, the move that we're seeing today, international stocks, like these 50% moves, they sound really cool, but international stocks moved up 600% to 1,000%. And I'm talking about the indexes. The indexes moved up that much in 5-6 years. So once again, like it's the environment you're in, and you got to trade the environment you're in. And so this ratio has definitely shifted. You could basically look at it over the last, 20 years and say, okay, yields are going up because copper prices are going up. Yields are going down because gold is going up. And you could do that over and over again. But now where we're at today, it's very similar to back then where that shift has happened because gold's the place where people go to hide, during some bad times. Now, we haven't seen the market really shift in that sense. So we haven't seen bad times in the market. Market still looks great. Still long the market. Nothing to be bearish about just yet. but I am seeing that this is a stagflationary style indicator at the moment. And I want to pay attention to this and see if this ever comes back into play and back into polarity, starting to move higher and get back to where that 10-year yield was. And so that brings us to gold. So we went from copper, now we're back to gold. Everybody's on here to talk about gold. Love talking about gold. It's one of those things that I've had for years. I was a kid going to the store buying little silver quarters and trying to ask banks if I could go through their go through their coins so I can get any silver that they possibly had on them. And then basically, if you found $10 worth of quarters, and let's say they were all silver, and you're making money on silver, you would just give them $10 and walk out. I don't know if they still let a random kid do that today, but you could ask. But getting into gold, gold is just trending, and the 16-year cycle was one that I was taught many years ago. And what's funny is it still has held up. I remember him talking about the bottom in 71, and like looking back and like to where we're at now, like those major lows, they still happened in a 16-year cycle. So right now we're still looking at like a gold bull run without a major cyclical low until the 2030s. Now, once again, cycles aren't something you can trade on and know, I know exactly what this is, especially if you're using leverage, especially if you're using options or swing trading. But like it does tell you the major moves that happen. So it kind of gives you some conviction on what you're seeing. Okay, we are in this major bull run. When does this end? I don't know. But here's, Sam has a fib target of 8,000. I look at cycles and say, okay, we could see it to this point. As long as the trend doesn't break down, we don't start making 52-week lows or something like that, I'm going to think it's possible because the market's proving my thesis. Like that's when you should get optimistic. You shouldn't get optimistic when the market is going against you. You should get optimistic when the market is moving with you and forward. And something that happened that Sam and I, that all the time, like basically we're stuck in this conversation over and over again for, I don't know, the whole time gold was consolidating this year, which was probably 3 months. Gold is done. What's next? Do we think that's like unraveled the whole commodity trade and the commodity thesis is over? And I would say no. You got the gold miners really outperforming. Like gold miners are up 100% this year, whether we're in GDX or GDXJ, they're both up over 100%. GDXJ is even leading a little bit. I think it came back, but now it's still leading. I think it was up 102 and 104 today. So when you look at these, you start to go, huh, okay, well, this is something that is really telling me that risk on is in this sector. And so as long as we're seeing risk on in this sector, it's basically telling us like, hey, I want to be in this. I want to be in these gold miners. And that level where miners were expensive, that's changed massively because gold has gone up massively since then. So if we're looking at gold, around 3,500, we can't say miners are expensive at the same point. So this could really go and be probably one of the biggest catalysts to continue to move gold. And I think now we end up in the silver miners. And I think that's going to be exciting for everybody. Basically the juniors, the explorers, all the crazy stuff that I never talk about that I am saying now in the last month that you probably want to be in the junkiest junk in the gold space. I don't say that lightly. It's not something I say much. So this was the other day. GDXJ was up 113% compared to GDX at 107%. This was on Tuesday. So looking at this, I want to stay long gold. I don't see any reason to get out of gold. Like everybody asks me every day, like, number one, I'm not going to change my opinion until the trend changes. That's number one. The first thing I'm always going to do, if the trend changes, you guys will all get an update. Well, the trend has changed. I feel differently about gold, blah, 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 like something like that. If the price is going that way, I'm good. I want to stay long the things that are going up and short the things that are going down. Like that's me keeping my trading as simple as possible. We as humans make it very complex, but trading is actually pretty simple. So here's a quote. All of humanity's problems stem from man's inability to sit quietly in a room alone. I was talking to my buddy Andy the other day, and we were just having a conversation. And we were talking about how simple trading is and how we make it complex. And then I said this quote and made me think like, I should share about that more. Because I read his writings. They're from the 1700s. They're really good, but it's basically just talking about how we never reflect enough, and I think this is even more important today. Like as humans, we don't reflect enough. We don't sit there and really just go, "Hey, I want to just sit here and think about what I'm about to do today." We just go, what are we going to do today? And if we got to think about it, most people are like scrolling on their phones or, listening to something or watching a TV show or, trying to get likes or, new subscriptions, something, whatever. Like they're doing that all day long. And really that's very distracting and doesn't allow you to just sit and think. And I think as traders, like it's something that you have to think about. Like JC said a good one, which was, he I forget who he said this to him, but they said, if you're paid to think, you need to schedule time to think. And I think that's really important. Like traders, we're paid to think. We're paid to not think and think at the same time. And even if you're systematic, like you're paid to think of new strategies or whatever strategy you're using or refining it or think about if your edge is working or if it's not working, whatever it is. And if you're discretionary, absolutely. Your whole job is thinking. So you really have to schedule time to think as a trader and not get too stuck and also keep things simple. Like it is simple. Like sit there and think. Okay, well, I'm long the position. Okay. How do you do that? So for me, I'm long a position until my signals say to get out. And it doesn't matter what I feel like. There could be news about, everybody tariff news. What's going on with tariffs? I don't care. It doesn't matter to me. Why? Because I'm already long. Let's say I'm short bonds. I'm already short bonds. That isn't going to change. I'm already long gold. That isn't going to change based on any news article or anything that comes out there or any of my feelings or opinions. What will change it is if I hit that sell signal. And so if that sell signal hits, then I'm out of there. So I keep it simple and I try to, be very meditative for trading. Like I really try to think about it, think it through, and not let my emotions get the best of me, because that's what used to get the best of me all the time. That's how I was a losing trader when I started, which is I get really excited when things went down because I buy them and then they kept going down, and get really upset when things went up that I was in. So I'd sell my profits and then watch it run, a lot more. I would just do everything wrong. And that's a way of kind of doing it right. So there's Sam's target, 8,000. So he's still looking for that target. Sam basically, sorry, that wasn't a fib target. It's basically the measured move. So old school technical analysis stuff, which is so cool that Sam does that even at his age. But old school technical analysis, we see the measured move from here would bring us to about $8,000. So anything's possible. Like you have to also believe that too, that things are possible. I don't know what the future is. Like that's the only belief I have. I don't know what the future is. Anything is possible. I'm going to hang on to this trend with both hands. Almost swore. I'm making it almost without swearing today. If we get through without like an F word, you guys are I should get everybody something. Get everybody a little present. Give myself one too, especially. So silver coming up next, cup and handle pattern quarterly closes. I've been highlighting this for the last month and a half. If we get that close above 37.60, I think we're headed to 50 quickly. We're all the way past, we're all the way up in the not mid 40s, but lower 40s at the moment. And we're chopping around. I think we're going to get that close. And I think towards year end, we're going to see that $50 handle on silver. So I'll keep updating everybody what I'm looking at, but this is exactly what I'm thinking right now. Country year-to-date returns. Greece near the top. This is where we're at today. What is the market telling you? And this is why I said at the beginning, we're going to be all over the place. Like for me to understand what's going on with gold, I want to know what's going on with international stocks. I want to know what's going on with currencies. I want to know what's going on with junior miners. I want to know what's going on with U.S. sectors and so on. So if we're looking at year-to-date returns, international is leading by a lot. Yeah, there's some countries that aren't doing that well, that aren't, above the S&P 500, but most countries are above the S&P 500 by quite a bit. So these year-to-date returns are strong. It's telling you that money is still flowing out of the dollar and into other countries, other currencies, and so on. and that we want to pay attention to that because the dollar is weakening and we are in a weak dollar regime. And this is an area where we can make a lot of money as well as continuing to look at these commodity stocks. So next up is US sector groups. GDX up there, XME up there. That's my biggest takeaway. Even MOO being, that's the agribusiness ETF. Even MOO being up there, in fourth place or fifth place, like that says a lot. Technology is usually the one that's always leading the way in the last few years, basically the last 15 years. So seeing like that, we're not only outperforming, we're massively outperforming it in metals and mining and GDX. That's pretty bullish for our trades. That's very bullish for our trades. What would make me extremely bullish on the commodity market? If we saw XLE start to move up. A lot of people don't remember just a few years ago, if you go to 2020, 21, 22, XLE was one of the top sectors and the top performing sector for a 4-year period of time from 2020 to 2024. Something to keep in mind. Currencies. Dollar is weakening and all the major currencies are stronger, especially in Europe, which, that's not something I ever had on my bingo card, being long, euros and Swiss francs, like the things I didn't think I probably would have in this year. But however, it makes the most sense. If the USD is really going to go down, the euro has to get strong. I do know that. I knew that. That's not the case. It's just seeing the euro this strong is surprising to me. I thought the euro would be like the underperformer, like more where the yen is, maybe 6% year to date, and then the rest of them being a lot higher. The euro being, it's 1 and 2 with the Swiss franc. That's pretty wild. I'm personally long the Swiss franc. I like the Swiss franc a lot more. So I think that's an area that you guys can continue to look at. And also the Swiss franc, I'm going to kind of hop through these things. I'm going to try to leave a couple minutes for questions before I have to dip. Swiss franc also has a lot of correlation to silver. This is something that Ricardo sent me. Wildly interesting chart here. He sends me it and he goes, what is the, what he sent it without labels. So it didn't have Swiss franc. It didn't have spot on it. And he said, what is this? And I sat there for a long time. Like I didn't say anything to him. I was like, I know this because I know this range here. I know this range, but I just couldn't think about it. I started thinking about energy stocks and all this stuff. And I go, Rick, what is this? He goes, I said, I knew this is silver, but what is this that's so correlated to silver? And he said the Swiss franc. And so, if you guys know, the central bank is in Switzerland, the Bank of International Settlements. Usually these two things have a very high correlation to each other. So it's something to continue to keep in mind as this trade develops. And so we're going to end with a couple of these real fast. So we're looking at silver, huge moves back in the 70s, 80s. Basically, this is kind of just showing you, against stocks, like the periods of time where you see this massive moves in commodities. Now, commodities have these that characteristic where they can move very quick and in a big way. Think about cocoa just last year or, 2 years ago, coffee last year. You get these 100% moves, or cocoa was like a 200% move. And it happens very quickly in a short amount of time. And then if you get the stagflation era, like you're having these huge moves happen, silver, 3,600%, sugar. And honestly, I could have drawn 50 different commodities during that time, but I just kind of held off. Oil had a big move very quickly with a 10x move very quick, 15x move very quickly. Wheat, palladium, nickel, natural gas. So, you want to be able to trade these things. So I think it's good to, like, if you can trade the futures market, you have enough money to, or if you just understand, like, your risk in it, because there's a lot of micro and mini contracts nowadays that you can trade that didn't exist when I started trading futures. So definitely look into the futures market, get an understanding, or list all the ETFs you can trade that are commodity based and continue to take signals in these as they go. And final chart is, where are we at in this bull market? So this is the commodity index. It's basically weighted very similar to the CRB with just a little bit more things. So it's a little bit wider. So you can get a little bit better of a picture of what's going on in the commodity market. You don't want to weight it too much, these things too much in like gold, because it would just look like a ripper here, and that doesn't really give you a good feel for it. So this still has a lot of energy. It's still mostly energy weighted, but we're seeing that we're still consolidating around this zone. And I keep updating that chart, which is like that massive Bollinger Band squeeze on the CRB index. When that thing starts to move, like that's going to be a massive move. And that's the thing we're seeing right now is TLT, huge band squeeze right now on a monthly chart. What else has a huge band squeeze on a monthly chart? CRB index. This is a decision point for these markets. And really, bonds have to die for commodities to really live and commodities really continue to move on. So I do think that we're still in this bull market, but we'll see where we end up. All right. I got time for a question. Put it at the bottom. I'm sorry if I missed stuff. It's only me today, so I'm just hopping back and forth with the chat. So anything at the bottom that you guys want to know, feel free to ask a question. I see. So where do you see the Canadian dollar going long term from Jonathan? So that's a good one. One to start out with. So one, go back to the video with Kevin Muir and I. I'll try to find this and post it on Twitter because it's come up twice. Michael Noss asked about it when I was speaking this week. And also, like, you just brought it up. So I'm going to post that on Twitter. I meant to do that the other day. I'm going to do that soon. But we talked about it because he lives in Canada. He's a currency trader. He's a macro guy. We had a great conversation about that. I don't know if the Canadian dollar is at a point where it can really catch a major bid. Will it move with energy again? That's to be seen. So maybe it starts to move when energy starts to move. I think that's very possible and something to keep out on the lookout. So if bonds don't die, Freely said, if bonds don't die, will American stocks continue to soar? So if bonds don't die, will American stocks continue to soar? Yes. So here's the thing about the stock market right now, and this is what I keep coming back to, which is, and this is what, everybody keeps going, well, bonds have to go up here, bond price, TLT, let's say, has to go up here because the pressure from the yields and so on is going to hurt the stock market at some point. How has technology been doing, which everybody said because of the valuations and because the way valuations are, they're priced to the bond market. Because of valuations, technology can't go up if bond yields go up. What happened? Technology went up with bond yields moving up. The answer is simpler than that, which is I don't know. There is probably a point where there's too much pressure on the stock market, but if the Fed's lowering rates, and like think of it this way, if the Fed's lowering rates, let's say both rates are here. The Fed is lowering short-term rates. And let's say long-term rates are moving higher. If that's the scenario, that means the yield curve is steepening. So bull steepener is what you'd call that. And that means there's more liquidity in the market. Things like regional banks do better in that environment. Banks do better in that environment because they're loaning their money. They get their money from the short end of the curve. So as the Fed brings down rates, they're able to loan money from there. And then as rates go higher, they're lending to lenders from there. So we, the normal people, the plebs, we have to pay the banks back at that higher rate of return when they're borrowing for, much cheaper. So I think that leads us into a sustainable bull market here. But I think it's just going to look very similar to today where we start to see like metals and mining outperforming. That's not a normal thing that happens. Metals and mining is the outperformer. Gold miners are the outperformer. Possibly energy starts to catch up. So I think the market just kind of shifts a bit. Even think of 2021. Technology was a laggard. Energy was a leader. Metals and mining did well that year. A lot of other things did well that year. So think of it that way. And that's really going to be the way you want to think of this market at the moment, especially because, look, it's in an uptrend. Keep it simple. When things are in uptrend, you want to be long. You want to be long gold. I want to be long the copper miners. I want to be long even, if you're big index level and you're just, retirement account, I want to be long the S&P 500. As these things shift, if TLT, which is just range bound right now, moves, then I want to follow it. Probably down. I'm already short. I've been short since 2020. I'm one of the biggest bond bears out there. And so, I've been short a long time. So I'm already short, staying short there. But if you don't have a position, if it goes down, I'd follow it. I'd short it. If it goes up, you could follow it, go long it. Same with XLEs, both range bound as well. I want to follow that one way or the other. I get a weekly close in XLE over 100, I'm going to a full position. If it starts to break down and bonds are going up, I'm going to be out of that position quickly. So, all right, guys, I got to run, got to go pick up the kids. I'll see you guys soon.